Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Hi, Jim. Here we are in a lovely day outside in Vancouver and a corrective day in the financial markets.
And as usual, we have questions from around the planet for Bob, and we'd like to thank our listeners for doing that. It makes the show very interesting and keeps everybody focused on what people are worried about. Our first question comes from Michael. Hi, Jim and Bob. I have two questions for Bob. Does weakness in the precious metals sector, as we're experiencing now, usually precede weakness in the equity markets? I've heard that when gold declines less than the gold miners and silver declines less than gold, as is occurring now in this latest correction, then watch for further sharp declines in the precious metal sector, followed by a breakdown in the equity markets.
Yeah, Michael, you're reviewing things well. I don't know about moves in the gold sector anticipating a move in the big stock market. I think I prefer to stay with the fact that if you get a major decline in the senior stock indexes, it'll bring down the gold stocks. I think I'll just stay with that one. So now, going into July, the upside in the action was terrific. As a matter of fact, we were getting upside exhaustions and as well as sequential sells on the leading stocks. So the advice then was that traders and investors could both take some money off the table. And it's turned out to be a good decline, a significant decline since. But now what you have had in the last few months is an eruption of fabulous speculation. And again, to go back a few months, in October, we noted that it was time for a seasonal low and that you could get a rally. And then also said that if the market is hot and crazy into January, it could be setting another one of these turn-of-the-year tops, like gold and silver to January 21st, 1980. The unique bubble in Tokyo took the Nikkei up right to the last trading day of 1989. So you've got a long record of very impressive speculations going straight up and burning out at about this time of month, January. So we've got everything in here. You got high valuations, you have high momentum, you have high sentiment figures, and all kinds of things at a time when this was possible. Now, there's another way of looking at this, and that's if the market had been on a steady rise to here without excesses, that would be a methodical trend and would likely continue, but we've gone crazy. So this is where you're going to come in with an intermediate decline. And now we had another part of the question?
Yes, we did. The second question, with call options and margin debt at record highs and no short sellers to be found, do you anticipate a rounded top at the equity markets or a trapdoor suddenly opening up without warning under the equity markets? As I recall, the 1987 decline was a trapdoor event without any definable catalyst.
Yeah, let's do 1987 first. That was a market that just became plain overbought, and you would have had an intermediate decline. But what kicked in was a bunch of invented portfolio insurance things that forced the most extraordinary selling, and it fed on itself, so you ended up with one day down 20%. So that was an incredible market item, but it didn't lead, and the economy was strong, everything was fine. So that was a curiosity more than something special. But in the market right now, you're right, the short sellers have been burned, and which is often the case at a dynamic high. So what unfortunately happens then is those future bids and short covering out there some months hence, they're not going to be there. So it'll add to the illiquidity in today's market. So I would say that the straighter up ones, and you see them from big ones to small ones, like Bitcoin big to small ones you can't even name. But the straight ups, they'll go straight down as if there was a trapdoor. On the senior indexes, they will just, what you want to look for is momentum failure, like the momentum's over, and then the other one taking out a low of, say, a month or so ago. We'll have to look at it and put our lines in the sand, and watch this market for the next decline. And Michael, thanks for the question.
And our question from Kathleen, I haven't looked at it, but I bet you there's musical references. Kathleen likes to add some music to the show, so get your inner jukebox ready. Kathleen.
Oh, yeah, we got Blue Skies.
Yes, there we go. Blue Skies. Anyway, Kathleen asks, Bob and Jim, it seems like there are only blue skies ahead according to this Business Insider headline. The bull market will continue in 2021 with stock market holdings well below dangerous global financial crisis levels, says J.P. Morgan. Market makers see only blue skies ahead in 2021 with the highly reported blue wave in the U.S. promising endless government spending and liquidity for the markets. And retail investors seem to be in love with the Fed. Irving Berlin's song Blue Skies comes to mind. Blue Skies was the most popular song in 1929. A year that many will not forget. And many retail investors associated it with the stock market. Lyrics, blue skies smiling at me, nothing but blue skies do I see, bluebird singing, etc. Anyway, Bob, is history repeating itself? Are we seeing another 1929 moment for the markets?
My God, Kathleen, that was an outstanding question, and I like your references to music, and there's a song you should look back at that time as well. It's a lovely one, My Blue Heaven by Gene Austin. The recording is great. Now, as to this one, oh yeah, it's wild, and as I said to the last question, it's going to go down, but here's a line that I used in yesterday's piece as a headline. Plutocrat socialists in Wall Street fund kleptocrat socialists in Washington, D.C. And this is what was going on. I couldn't believe it, but Wall Street did fund the Democrats. And now the Democrats are now saying that they're going to come in with lots of rules and regulations which will prevent a setback. And then, it's all amazing that the Wall Street are funding a bunch of socialists, and the socialists will bring financial and economic problems. It's just the way it's going to go. But careful money will be leaving because money within the United States is now at risk, at political risk. So, not a good situation.
Bert Wenkenbach from the Netherlands asks a lengthy question, and of course we'll ask that question. Bertie's worried it'll take too long. We're on the internet. We have all day. Bert asks, as the financial crisis of 2008, or after the financial crisis of 2008, the Fed started to expand their balance sheet from $2 to $4.5 trillion in 2013. They did this by buying long-term debt and treasuries in an attempt to lower the long-term interest rates. Then they kept the balance sheet on this level until 2017, implying that the net purchase of treasuries by the Fed was zero. In 2017, they even started to reduce their balance sheet in baby steps, probably not by reinvesting in bonds as they expired. But in September 2019, they reversed that policy dramatically months before the outbreak of corona. This coincided with a sudden severe liquidity problem in the repo market, but it never has been clear what actually happened. My take is that because of the threat of even the smallest rise in long-term interest rates, one of the big financial institutions got liquidity problems, or was there at least the fear that this was about to happen? But which institution or bank was it? Can Bob give us his thoughts about this mystery?
Yeah, Bert, hey, that's a lengthy one with numbers and all. But when the repo crisis arrived, we were good on that one because earlier in the year, like March kind of thing, you had the central banks in Argentina and Turkey suddenly without liquidity. So then what happens is their short rates jump and their currencies plunge. And then maybe in May you then had similar problem in India and China. So that was real easy. We just said, okay, now the line of progression will be quite likely that a liquidity problem will be discovered in the United States in the fall, like October. And I think it started on September the 9th or 10th. And what it was at the time is that really day-to-day liquidities vanished. J.P. Morgan and other big banks just took their liquidity out of short term, and I think they went long the bond market, which turned out to be good trade for them. So the key on that was as all the way back 2,000 years ago when the Roman writer Cicero noted that if you have a financial problem in the eastern provinces, like then the Middle East, that financial crisis would eventually hit Rome, which was then the pattern. And then now, of course, it's the same thing. You then have a crisis discovered in an outlying region, and it eventually hits the senior market. So, a good question. Oh, also on the previous question, one of it was this like 1929? And we would say not specifically, but 1929 was number 5 of the great financial booms that started with the first one, the South Sea Bubble in 1720. Now, each of those have had similar characteristics. On the way up, and detected in credit spreads and the yield curve, in real interest rates as well as the real price of gold. So we can say that this current bubble seems to have many of the characteristics of a classic bubble that were not quite all there in 2007, and yet you had a very good contraction after 2007. So probability is that there is a serious contraction pending. And because what you get is always after you have huge inflation in financial assets, which we're getting now, it doesn't go to huge inflation in commodities. It goes to huge deflation. So that's the way it's worked in the past, and I don't see any reason why it would change.
And we have Frank asking a question. Hi, Bob. Bill Gates and his fellow billionaires are heavily investing in farmland. Is this a smart move by smart people, or is this another example of Warren Buffett buying ConocoPhillips right at the top of crude oil priced above $140?
Yeah, Frank, thanks for reminding us of Warren buying the top of the oil market. Now, real estate price indexes were kind of hard to get, and I did stumble on one a long time ago, and it was in England, and it was called Farmland Value. Yeah, Farmland Values or something like that. And the study was specifically from 1873, which was the top of that bubble, down to 1895, which was the end of that Great Depression. And that index went, I haven't got it in front of me, but it's sort of like from 58 on an index down to 38 in 20 years, and with no up years in it. So that post-bubble deflation was really quite something when looking at farmland values. So then, of course, we know that following the 1929 boom, that farmland values in the United States, there is an index for that one, and it fell very hard and was really bad because you had the extraordinary condition where in the previous expansion of farms in the Great Plains, many of them ended up in areas that were subject to drought. So where the Great Depression in England and Europe was serious, it didn't include mass migrations of people being forced off of suddenly unproductive land. So that was a horror show for North America, and particularly the United States. So anyways, the probability is that most classes of real estate will decline with deflating prices for financial assets. It's the way it's worked in the past.
And Bert signs off his message with Met Vrenjilike Gruten, which I probably totally slaughtered, but it translates to yours sincerely. So thank you very much,
Frank
Bert.
Must be in
Netherlands.
Netherlands, yeah.
One of my favorite holiday spots.
Yeah. Yeah, well, they're underwater all the time there, aren't they?
Yeah. That's right. Those tulip investments were always underwater.
I think the average land level in parts of Holland is at least 50 feet below sea level.
I remember the city manager in Richmond got upset with me when I said Richmond was always below sea level, and he says, no, we're not. For 13 hours a day, we're above sea level.
That's a good one. Yeah.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Bob Hoye. Bob, one of the headlines that caught your eye, adrenaline-fueled rush for small caps.
Yep, it's small. Some of them are small caps that only small investors are buying, but eventually they get enough volume going that maybe some smaller funds can come into them. But that's a topping sign when you've got small people playing in the small stock market. It's great when you're in it and it's working for you, but it can go away all of a sudden, kind of thing. So, but it's a sign of the times. That's the key thing.
And we have the now things you can trade on your phone, the Robin Hooders who think they're not paying to make the trades, but of course their trades are sold to somebody else, and they'll, knowing how much volume is going into that particular product, snap it up just before the other people know about it.
Oh yeah, that's called front running.
Yes. So There is a price to be paid, you just don't know about it.
Mm-hmm.
Another headline, China's momentum-obsessed traders push stocks to 2007 levels. Well, we know what happened in 2008. Is this another precursor?
Yeah, it's interesting that they were able to get back to that high, where the New York Stock Exchange indexes are way up in Never Never Land. So, anyways, it's another sign of hot action, and it's everywhere.
We'll have more with Bob Hoye right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, a headline says the rich are pulling in money like crazy since the so-called recession started.
Yeah, it's amazing that those who have been successful and learn how to play the financial games can always take advantage of yet another leg up in the market. And certainly, virtually everybody got whacked on the panic into March, but then the V bottom came in, and it's been straight up and beyond for many indexes, and for some stocks it's just been, some guys put together an index of stocks that were making no money, and they weren't the big ones. I think they were called, the big ones with no money are called zombies, but this one they called no money stocks, and it went from 80 in March, and I think it's now, let's pick a number, 450 or something like that. So a huge gain for this index of small, hot stocks that aren't making any money that this financial writer put together. I thought it was a great idea to do it, and I really enjoyed the chart, and we published it yesterday. So good stuff.
Biden Wall Street watchdog promising a new era of tough oversight on the financial sector. Will they be tough?
Yeah, they will be tough after the event. Now, this is the thing. In 2008 crash, of course, it was caused by George Bush, that they had reduced regulations and rules and stuff somewhat. And then you had what was a natural speculation brewed up. They always are natural. It's the public that chooses whether to speculate in commodities or to speculate in financial assets, and that was another one of those. And they get overdone, and then they come down. So, but then there were a lot of headlines in 2008 that if there had been regulations there, this would not have happened, and they're going to do it this time as well. But one of the things was, in the early 1930s contraction, the policymakers then were somewhat practical, and they came in with the Glass-Steagall Act, which separated Wall Street banks from commercial banks. And because the problem then was all banks were playing the financial markets. So that was a nice idea. And then it was up. So then I guess it was 1988 or 1999 when then they decided to throw out the Glass-Steagall Act because many commercial banks, ordinary lending agencies, were fully involved in Wall Street. It was happening, so then they got rid of the act. Now, this goes way back to the South Sea Bubble in 1720, when in the spring of that year, the key stock, the South Sea Company, was a quasi-government company that was helping fund government. And they wanted to keep the play going and exercise warrants and stuff like that. But then, because of the bubble, all kinds of other people were coming up with new issue stocks, which was taking money a wave that might have gone into their South Sea Company. So they came in with the Anti-Bubble Act that, hey, no more bubble stocks. And guess what? The next bubble brewed up in 1772, and going into that, Parliament in England took the Anti-Bubble Act off the books so that everybody could party. So what happens is that in the crash and the recession, the policymakers are like closing the barn door after the horse is out and putting in all kinds of restrictions. And then, 30 or 40 years later, you get into another great financial bubble because everybody's forgotten about them. And they crash, and then, before they crash, the policymakers take off restrictions. And then they crash, and then the socialists, of course, want to come in with the restrictions. So I think we're going to go into a contraction, a recession, or whatever you want to call it. Hopefully, the critics out there and the financial journals and whatnot lay the blame on the Democrat administration, and but that all of them, whether they're Democrats or Republicans, they will then go around closing the barn door after the horse is gone with rules and regulations like you wouldn't believe, which then make the contraction even worse. So, Jim, it's going to be very interesting times.
Another headline that caught your eye: conservative news outlets need new platforms.
No, they need to be deplatformed.
Or deplatformed.
Yeah,
really?
yeah. What that means is the left now doesn't want to debate an opposing point of view. It does not want an opposing view, so they're eager to shut down any of the sites that carry a conservative point of view. And as we saw, that happened with Twitter when they shut down the president's Twitter account. I mean, that is unbelievably malicious and but purposeful. They do not want any alternative view to be viewed, and even small voices like myself at some time under this administration, or if the Trudeau administration continues in Canada, they'll be out to silence me or anybody else who can articulate a conservative point of view. They won't debate us. They'll end us, is the sad thing. Anyways, while a recession under a Democrat administration may have its certain schadenfreude, but what is going to be dangerous is what it prompts those authoritarians to do, and it is not going to be pretty. So, what did Roy Rogers say? Happy trails?
Hi-yo, silver away. Silver going away.
That was the Lone Ranger.
That was the Lone. I'm sorry, I get my cowboys mixed up.
Yeah, you're just a young guy, so you weren't really there.
I had a Roy Rogers canteen and chaps and
wow.
And 6-gun.
No, that's something.
Set. Oh yeah. Because I remember using the water in my Roy Rogers canteen to put out a campfire that my 5-year-old buddy started, and I got spanked for.
Yeah, well, my mom's sister, my aunt, was working at the big department store downtown, and one Christmas when I was about 8 years old, I got, as a gift from her, the cowboy belt with 2 holsters and 2 pistols in it. I mean, you couldn't get anything better.
Bob, always fun chatting with you.
We look forward to next week, and in the meantime, you have a good time.
We invite our listeners to send their questions to Bob at info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter at House Street. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.